for tuning in to the Paycheck Protection Program overview for Vermont's child care providers. My name is Beth Trzanski. I'm the Deputy Director of Building Bright Futures, and we're happy to host the webinar today. Hopefully it will be informative. And we have some panelists for you to share information, and we'll follow with question and answer. So it's probably best to hold your questions for the presentation, and then as we get to the end, we'll prompt you if you have other additional questions that we can answer for you. So Building Bright Futures is Vermont's state early childhood public-private partnership mandated by Vermont's Act 104 and the Federal Head Start Act to serve as the state advisory council. We are really working to create a more coordinated, effective early childhood system. And when we talk about early childhood, it's everything from the prenatal period through age 8. So working with regional councils as well as the State Advisory Council. And the trivia fact for today is that Building Bright Futures is actually different from Bright Futures Information System. That's often a confusing fact that they have very similar names. So we have Melissa Regal-Garrett from the Child Development Division joining us, and Susan Mazza from the Small Business Association. I'm going to hand this to Melissa to give a little update about what's going on with the state, and then we will move in to learning more about the Paycheck Protection Program with Susan.
Great. Thank you so much, Beth, and welcome everyone that's able to join us today. We're really excited to be able to co-host with BBF this presentation on the Paycheck Protection Program for child care providers. My role really is to just give a brief overview of a different funding opportunity. Back in December, Congress passed a new COVID relief package that included additional relief dollars through the CCDF funding program. And those dollars are specific for childcare and families accessing childcare. We did get our award letter late last week, and we're in the $12.2 million range of funds that are coming to the state from the federal government. So we're excited to figure out exactly the right way to offer those funds out to childcare programs in Vermont. What we understand from the bill is that the funding comes to us as the child care lead agency, and we can issue grants to assist child care providers. And some of that is assuring that folks can remain open or reopen. The funding can be used for fixed costs, for increased operating expenses, and also provide payments in the event of decreased enrollment or closures related to COVID-19. In addition, we can also use the funds to support families in paying for the cost of childcare, including essential workers, even if they don't meet the income eligibility requirements for our childcare subsidy program. One other requirement of this bill is that we provide technical assistance regarding the funds to ensure that families and child care providers are aware that they're out there and they understand how to access them, and they have the support they need in order to access those dollars. So this is like phase 1 of that. So we need to submit a report to the federal government by February 25th on exactly the design of the program for accessing those dollars. And we are looking at the operational relief grant program that we ran last fall as the primary model that we're going to use for that, mostly because that seemed to offer the most flexibility for providers to be able to determine how they wanted to use that, whether that was for fixed costs or for backfilling tuition or those kinds of things. So We do anticipate being able to reveal exactly what that design is prior to February 25th, and have programs ideally be able to start applying for that by the end of March. So that's our program. We do see a relationship with the Paycheck Protection Program, in that as folks apply for our program, we'll be asking that the expenses that you're applying for are not the same things that you'll be applying the Paycheck Protection Program funds that you receive towards. And so that means an overlap in time period and use. So it's potential that you may use your Paycheck Protection Program during the dates that the PPP program is allowed. And then you might actually use the funds that Vermont will provide through the CCDF application process for a different time period for the same use. So we'll have a lot of details and information on how to tell that apart and make sure that you are aligning and making the best use out of both funding sources when we go ahead and have the details on our programming. So I will stop there. And if there are questions, I'm happy to take them.
Great. Thanks, Melissa. Any questions? Certainly more information to come. So folks should be patient and look for that, and we'll help to get that information out as well. But if there are questions, you can put those in the chat bar. Okay. Why don't we move on? Susan, thank you for joining us from the Small Business Association. I'm going to hand this over to you. You can share your screen as you need to. Here we go.
Okay, now I had forwarded the PowerPoint to you folks ahead of time. I didn't know, to be perfectly honest, I was kind of assuming you would be sharing it through that.
Yep. All right, I will pull it up. Why don't you start off and I will bring it up in a minute.
Absolutely, thank you. I'm just afraid I've got so many things open on my desktop right now. Didn't plan on that. Hi, everybody. I'm Susan Maz. I'm the Deputy District Director here in the Vermont District Office. I'm with the Small Business Administration. On the lineup here as well, my District Director, Darcy Carter, is joining us today. And we were going to be talking about the PPP program and how childcare businesses, both licensed and in-home providers, can take advantage. The dates of the presentations, whenever I do a presentation, I always date them. So you'll find that on the very first slide. And just a little disclaimer as I go along, I'm trying to make things understandable, although sometimes some of the idiosyncrasies and the distinctions really come down into going down into the weeds. So to the greatest extent I can, I'm going to be trying to really share this with you. I have a copy of the PowerPoint, Beth, in front of me. So if it's easiest to share with everybody else, and then I'll just move through this. Whichever way.
Getting it set up, but here we go.
Sorry. Out of the preliminary time period, I should have taken care of this. Thank you very much. So, thank you. Okay, next slide. Thank you. Okay, so what's in it for you? The whole issue with this particular program, it is really not a normal loan. There was a purpose and an intent to the legislation, which originally stood up the PPP program. The purpose of the program is to provide direct incentive for small businesses to keep the workers on payroll. That's the point. And some of the rules around everything are really meant to incentivize businesses to do just that. Now, you can use the funds for the eligible payroll costs, as well as other non-payroll costs, as long as they're in the eligibility category. Payroll costs is a pretty wide bucket, and I am going to go through with you a little bit later all of the different kinds of things that can come into play. But now we've also got some expansion in some of the expenses that you folks could potentially have forgiven. So there have been mortgage interest, rents, utilities, and things like that. But now there's additional information or different categories, such as supplier costs and expenses for operations, PPP, worker protection costs. So all of these different things have come into play. So those are really good things that you can use these funds for. And at the bottom, potentially the whole thing is forgivable. Forgivable meaning there are certain types of criteria that SBA did put forward to make sure that the the intent of the program is being served. I mean, we are taxpayer dollars, but also to ensure that eligible costs are what you're using the money for. It's not just a carte blanche. You get to the end of the day, you use the funds, and you get everything forgiven. So there's some rules of the road there. Okay, next slide. So the terms. This time around, these first draws are what they're going to be called. Anybody who's had a loan up until now, PPP loan, as well as this particular version, they're all being referred to as first draw loans now. And what that means is you're going to be calculating your payroll costs, average monthly payroll costs. You're going to multiplying it by 2.5, and that's going to give you the dollar amount of your loan. A very simple calculation. Maximum loan amount is still $10 million. Interest rate is only 1%. And I will tell you that if you get forgiveness, that includes the interest. You won't have to pay that either. Or if for some reason there's a remaining balance, you'll have the interest forgiven for the portion that's forgiven. So a lot of this is really coming through where you're hopefully going to be able to have the whole thing forgiven. Now, the loan payments of any kind do not have to start for quite a period of time for you. So once you close, you're going to be given up to, or actually 10 months after the end of your covered period, and I'll explain what covered period is, before you have to start making any payments. Now, if you do apply for forgiveness before that time, if there are residual funds after that's processed, if there's a remaining balance, that would be the point that you'd start repaying. But basically, a covered period is this time frame right after you close, where you're supposed to be using the funds for the appropriate purposes. And then at the end of your covered period, you have another 10 months after that before you have to start making any payments at all, if you don't want to. Otherwise, you do so when the forgiveness is processed. So there's a good chunk of time there. That covered period can range anywhere between 8 and 24 weeks, anywhere in between, depending upon how you've used the funds and what time frame you want to identify. Now, the great thing is no collateral, no personal guarantees, and neither the government nor the PPP lender is allowed to charge you any kind of small business fees attached to this. It's got 100% SBA guarantee. So the guarantee runs to the lender, so they have a lot more comfort being able to process such an unusual type of a program. And the loans are obtained directly from a lender. You don't go into the SBA. You're going to be going to a PPP lender to gain access. And there's many, many, many of them in the state. And you also have a situation where there's a mechanism on the SBA.gov website where you can go in through a thing called Lender Match and find a PPP lender if that's the way you'd like to do it. Next slide. So this is it in a nutshell. I particularly like this slide. I think it crystallizes everything. So you have this 2.5 months worth of payroll. Left side is all about the eligible uses of the funds. You have payroll costs, and that's, as I said, that's a wider bucket than you think. And then you have interest portions on mortgage obligations, rents and leases, utility payments. All of those need to have been already in place prior to February 15th. So they can't be new obligations that you've started up. But then it's also going to be widened, as I said, into operational expenditures, property damage costs. I don't think this applies to Vermont, but in other parts of the country where there was civil unrest over the last year, there are some areas where there was some violence, property damage, and it could be going towards that if it wasn't already covered by insurance. Supplier costs, and then worker protection. There's more detail about what these things might look like, but that's it in a nutshell. So you have all of these eligible uses. All of those should be taking place during this covered period, which begins on the day you close the loan. You don't have a choice in that. The minute you close the loan, you get all the money, and then you have this covered period to spend these funds. The right side are the different types of forgiveness criteria that you're going to be asked to comply with. There's 3. The first one applies to absolutely everybody. And this is the issue where we're expecting you to use most of the money for payroll costs, and then a limited extent for the non-payroll. So you need to be using at least 60% of the loan amount for payroll costs, eligible payroll costs. Next item is a salary and wage reduction can be no more than 25% during the covered period. Now, all of these are going to sound like, well, what does that mean and how do we calculate that? And trust me, I do a lot of work doing webinars on a regular basis that explains all of these things so that you don't have to be questioning this all the time. What we're basically saying is the rate of pay that you're paying your people. We just don't want you lowering it more than 25% compared to a benchmark. You can lower it down to that, the rate. I'm not talking the total compensation they're getting, just like hourly rate from $20 an hour to $15 an hour. But if it's more than that, there's going to be a reduction to your forgiveness. And then the last one is that we are expecting borrowers to maintain the average number of full-time equivalents employees during your covered period as compared to a benchmark period. And these are incentives to try and make sure that the borrowers, you folks, are going to be actually trying to meet the intent of the legislation in the first place. It's very important. So the 60% applies to everybody. The next 2 areas applies really in terms of forgiveness amounts. It applies to anybody with a loan amount of $50,000 and above. Those with loans less than that. So if you have a really small PPP loan, those second 2 criteria are not going to be impacting your forgiveness. That's something to know right off the bat. It may make you feel a lot more comfortable going forward with a small loan. Okay, next slide. So excuse me, I have crib sheets here. You can apply through a PPP lender. Just about every lender in this state is an authorized SBA PPP lender. Most of the lenders in the state were already SBA lenders, but there's a particular designation for a PPP lender because so many more lenders got involved to be able to process these loans. There's thousands across the country. Now, the bank or the credit union you normally go to might be the best bet. They may already know you. You don't have to go through verifying your identity and that kind of information, which any lender is going to have to do. They have to know who their borrower is. But it just may simplify things if you can go right back to the same lender that you've been working with or the same place that you have your deposit relationship if you don't have a loan relationship. But there are also other sources to consider. There's Vermont Community Loan Fund. Many of you may already be aware of them. They really specialize in childcare, but they're willing to look at very small loans. And then VEDA, Vermont Economic Development Authority, they too are willing to take a look at some very, very small loans. Now, I know loans can be down as $1,000. I've known some to even be smaller. Does not mean you have to be coming in for large pots of money. And depending upon the size of your payroll costs, you really may be looking at some smaller money. But keep in mind that there's always sources, always places to go. And wherever it is you go, there will not be any distinction between the terms that you get. You're still going to get the same terms as if you came in through the big bank down the street. Now, the lender is going to be reviewing the application. They have been given guidelines so that they don't have to get too deep. They're going to be relying to a great extent on your certifications. And then what they'll do is they will submit that application and the information along with their own application. They have a companion application to the SBA through a special computer portal that's been developed for this. Once that loan is approved by SBA, a guarantee number is going to be generated, and the lender has 10 business days to close that. You can't delay having that done. It needs to be done within that 10 business days. And when you close, you'll receive all of the money all at the same time. So it's not a little bit now, a little bit later, or anything like that. You get it in one chunk. Now, the loan application process is very, very fast. Slightly slower than it was in the first round, simply because SBA to try and protect against fraud and abuse and things of that nature have added a few edits to it. But especially for a first draw loan, those are going to be relatively limited in scope. So typically these can happen, we're expecting maybe every 2 or 3 days. And once that happens, that lender needs to get that money out the door. So there's a lot of emphasis there on getting everything moving. Okay, next slide. So as I said, you're going to have a special time period after you close that's going to be referred to as a covered period. You're going to get pretty used to that term. During that covered period is when you need to be using all of these monies, trying to hire people back, maintaining their compensation rates, things like that, using it for the eligible purposes, trying to make sure that you're using it appropriately for the payroll primarily, because your non-payroll will always be limited as compared to that payroll amount. And then once you've used the funds, you can apply for forgiveness. There's a few different applications you can use. I routinely, once a week, do a forgiveness webinar to explain what they are, what they look like, which one can you use, things like that. But in the meantime, the lenders are responsible for servicing the loan, answering questions you may have. Most lenders that I know are in a process of they're constantly communicating with their PPP borrowers, keep them informed as to what's going on or what kind of a time frame are you coming up to. And then when the forgiveness application is processed, you'd be going back to that lender. And if it was the local bank, it would be the local bank you go back to for the forgiveness. They'll be taking a look at that, making some decisions. They'll be forwarding that information to SBA. So hopefully the full amount gets forgiven, all is good. If there's a residual balance, the lender will be working with you to start the repayment period. So the total loan needs to be completely paid off by the end of your term. Now your term, actually, I may not have put that on that slide. It's 5 years for all of these. Early on, it was only a 2-year term, but now all of the newer loans are 5 years. So the day you close the loan is the day the 5 years begins. And during the next 5 years, you'll be using the funds, seeking forgiveness. And then if there is a remaining balance, you'll be paying that lender over time to make sure that the loan is expired by the end of that 5 years. Okay. Next slide. Now, what do you need to do? It's really pretty simple, although it can be intimidating, I think, when people are going through their own documentation, trying to figure out what's eligible and what isn't eligible. But the basics, you're going to be gathering payroll information that will document both the numbers of employees and the dollars, as well as any additional costs related to payroll. Now you're going to be calculating the payroll costs as the law requires, and you're going to be providing documentation to the lender to support that. So that's one of the things you're going to have to be bringing in. Now the application itself you can download from our website, and in a slide or two here, there's actually a hot link, so you'll be able to do that. Part of that application is going to be a matter of making sure that you're signing off as to the accuracy of all of the information you're providing, the accuracy of your calculations. There's a number of different questions I'll go through a little bit with you that has to do with certifying to certain claims you are making. Now, the accuracy of that form is your responsibility. And the lender will be reviewing it, but as I said, they don't have to go down into the weeds here. They rely on your certification, so you want to make sure that you're reading what you're signing and what you're checking off on. Now, the lender may need additional information, as I said, if they're a new lender, a new relationship to you, or any other thing that really needs to be clarified. The application form provides distinctly lots of information, very densely packed on small pages. And to some extent, I've tried to break it out a little bit in some of the content in here, but it's going to explain to you exactly what is an eligible payroll cost. How do you do that? What you can include, what you can't include. There's even a form to help you do the calculations themselves. But as I said at the bottom of the slide here, you must submit the documentation sufficient, one, to establish the eligibility of your business, and to demonstrate qualifying payroll tax amounts. And they give you some suggestions as to what that might be. Next slide. Now, who's eligible? It's kind of easy for us to be able to do a webinar with just this one industry type rather than going through all of the different industry types, who is, who isn't. Childcare businesses are generally eligible. For-profit and not-for-profit C3, 501c3s are eligible. The one thing about eligibility right off the bat, however, though, is if you are a sole proprietor and you're using a Schedule C and you have no employees, your bottom line, the net profit on your Schedule C, needs to be above 0. If it's 0 or below, that is an ineligible applicant. But if you do have employees, it's a different calculation. So that's a different issue there. But eligible small entities also need to be included with affiliates. There's a term for if you have different owners of the company that happen to have other relationships, other companies they're related to, it's going to form an affiliate structure. So the complete structure needs to be looked at to be eligible as well. Now, the size limitation is 500 employees and less. Now, that's probably covering just about every childcare business that I know of in this state. However, if you have affiliates, you need to add them all up together and be small. So that's something, a little bit of a caveat there to keep in mind. Now, there's other ways of qualifying. If you can qualify under our normal size standards and so forth, you could always call us and we can get you more information about what that means. But it's also an area where there's probably a lot of, my guess is you're a lot smaller than 500 employees. Now, there's a couple of things there too, though. If for some reason you are part of a franchise, if there's a childcare franchise and you are the franchise owner, what you need to do is look at if you are a franchise that happens to have an SBA franchise identifier code. That's great, because then all you have to worry about is your one little piece of that big enterprise. If there is no SBA franchise identifier code on that particular franchisee, then it would not, you would have to look at the whole structure as if you were one entity, as if they were all affiliated. So if you need to know, if you are a franchise, want to know about that, if you don't know about that, you can easily talk with your lender. There's a code registry, right, that they can get to. You can call us and we could tell you as well. Now, the other caveats here is you need to have been in operation as of February 15th, 2020. So if you've just started up since then, that is ineligible. And you cannot be permanently closed. So even if you were open on February 15th, if you are now permanently closed, you are ineligible. Now, the next slide gives a few other areas of issues that could potentially make you ineligible. That really has to do with things like, of course, if you're engaged in any illegal activity. Household employers, we've determined, are not employers for purposes of a PPP loan. So if you're an individual who employs household employees such as nannies and housekeepers, if it's anything like that, that's not considered a business. This next bullet here has a lot of words there. I can't take words out because then it changes a lot of the meaning. This has to do with things like your personal credit character issues. If you've been arrested, if there's a felony involved, different types of things like that. The rules for PPP have been eased considerably for a PPP loan. The easiest way, my little suggestion to you is when you go through this, it's going to be broken out into a way that's a little bit easier to digest on the actual application. So it's going to be asking you if any owner of 20% or more, if you happen to have been subject to a felony within the last year, you're ineligible. If you have sometime in the last 5 years been charged and convicted of a felony regarding fraud, bribery, embezzlement, and false statements in loan applications. But there's a lot of other types of felonies, to be perfectly honest, that would be okay. If it's that kind, they're not okay. So as I said, the actual application process has this separated out, and I'll show you where when we get there. Now, the other issue is that you've ever received a direct or guaranteed loan from SBA or any other federal agency that is currently delinquent. I mean, we're talking student debts and things like that, or if it's defaulted and resulted to a loss of the government, that's ineligible too. So it's any kind, if it's a home loan, if it's a student loan, things like that, those may be, or if it's an SBA. So if that's the case, that could make you ineligible. Next slide. So as I said, the great thing is there is this wonderful document out on the website called How to Calculate Loan Amounts for First Draws, And it's going to be broken out based on your form of organization and how you file your taxes. And it will give you very explicit instructions how to calculate your loan amount. What I'm going to show you here or next actually is if you were a sole proprietor with no employees. I'll actually show you what they look like. I'll also be showing you the Schedule C with employees to get a sense for the different kinds. But there's going to be one in there for C Corp, S Corp, things like that. But right off the bat, this time around, if you're applying now, you're going to be able to use your financial records for payroll costs from either 2019 or 2020, either one. And the instructions are going to actually really lay out to you what time frames you need to be looking at. Let's say if you're a pretty new employer, let's say you started at the very beginning of January 2020. That means you don't have 2019 records to look at. How are you going to look at like 2.5 months worth? So basically you can look at those two, but then when you get into the meat of the details of this document, it really explains what you need to be doing to look at. So right here on the screen, there's the first draw loan application. That is a hot link. You have this slide deck and put it up into full screen mode. You can actually link right there and get to it. And then the second one is how to calculate the first draw PPP loan amount. Next slide. But before I show you the Schedule C, what I do want to go over is all the different types of costs for payroll that you can include. Salaries, wages, commissions, things of that nature. Cash tips based on employer records of past tips. In the absence, such records, a reasonable good faith estimate. Payment for vacation, parental, family, medical, or sick leave, allowance for separations or dismissals. It's a pretty wide bucket. But then what's also included as a payroll cost is the non-cash category here. And that has to do with things like group healthcare coverage, insurance premiums, retirements. And this actually includes vision, dental, group life, disability, all of those different categories you would be adding up. So it's not just the cash you're giving your employees, it's going to be the cash plus all of these other benefits you may be serving up. It also includes state and local taxes assessed on the compensation that you as an employer have to bear. And if the way we look at some of the compensation for different types of organizations, such as sole proprietors, it's basically going to be driven off of other forms of compensation, whether it's 1099s and Schedule C information and things like that, rather than actual payroll records. So again, to remind everybody, 60% of the loan amount you should be using for these costs, but at the very least, forgiveness, out of the forgiveness amount, at least 60% of it needs to be supported by payroll. We know many borrowers who actually do all of it for payroll. That's all they use it for, and that is perfectly great. They just cannot be using less than 60% of that, because that non-payroll is going to be limited. Okay, next slide. These are the few items that you cannot include. So if for some reason you have an employee whose principal place of residence is outside of the US, I don't know how that would work here in Vermont, but you cannot include them at all in the calculations. The other thing is if you happen to have any high wage earners or are a high wage owner, and when I say high wage, I mean anything above $100,000 on an annualized basis. If you have any employees like that, or you are an owner with that kind of compensation level, we are going to allow you to look at forgiveness, but only up to that $100,000 level, prorated down to your covered period. So that applies to both owners and owner employees. I'm sorry, employees and owner employees. The other thing you cannot include are things like the federal employment taxes, FICA, Railroad Retirement Act taxes, and then the qualified sick and family leave wages under which the credit's allowed under the 7001 and 3 of the Families First Coronavirus Response Act. Now, I know I often say this, if people are curious how you look at this, how you'd actually add things up, because some borrowers find it counterintuitive to say, yes, you're supposed to be looking at payroll from a gross perspective, but then we don't want you to include these things. We have a PPP FAQ out on the website full of great information, and there's question number 16 specifically covers that particular topic and has really good explanations as to how you look at that. Next slide. So this is what it looks like. Borrower application form 2483, first draw PPP loans. So it is actually pretty self-explanatory. You're going to be identifying what are you? Sole proprietor, independent contractor, self-employed individual, 501c3. But also remember, it's very important that you put accurate information in here based on your tax returns. And if you have a DBA or the trade name, the year of established, business legal name, NAICS code, that's your industrial classification code. That would be on your tax returns. That would tell you exactly how you've been filing. Now that next block to the right, applicant, including affiliates, that is if you add all of your number of employees up. And for purposes of size, you're going to be looking at head counts. You're probably in the no more than 500 employee range. And then further down, a couple of lines down below that, there's a number of employees you're going to be putting in right there. That's a head count for purposes of that block. That also, if you're a sole proprietor, what you want to do is make sure you count yourself. Can never be zero if you're gonna be applying. You're going to be calculating your average monthly payroll using the instructions to help support you. You're going to put the average monthly amount in that far left block. And then what we're going to ask you to do is multiply it by 2.5. And that next block, the dollar amount, would be exactly what your loan amount would need to be. Now there's some language in there that talks about the idle. Do not include any idle advances equals loan request amount. In Vermont's case, there were no Vermont businesses that received an idle loan, economic injury disaster loan, during a specific window that is necessary to have that item put in there. So you don't have to put anything in there. As long as you're from Vermont, and that applies. So it looks a little more confusing than it really should be. So you just multiply the average monthly payroll by the 2.5. The next section is simply to check off obviously you have to check off payroll costs that you're going to be using it for that. And you can check off all of those other things too. You can use them or not. You do not have to, for example, if you only check payroll, does that mean when it comes to forgiveness that you can't include things like utilities? No. Just giving an indication of the things that you are intending to use it on. It's also a way of reinforcing with you what are eligible costs and what are not. Okay, next slide. So this is the section I told you about where it kind of breaks out some of those character issues line by line. So it's a little easier to swallow and digest and make sure you're answering correctly. But this is the bottom half of that first form, and it's going to be going through exactly who is the ownership of the company. If it's one owner, if it's 10 owners, you'll need to add in an attachment, who they all are. And then the answering the questions needs to be applied for all of them. So it's pretty simple. If you're debarred from doing with a business with a government, you want to make sure you're reading each one of these. Don't just check. Don't just assume you have to check. And it also clearly lays out that if you answer yes to very specific questions here, it's an automatic not eligible. But some of the information in this section is simply informational for determining other types of eligibilities like franchise codes and things like that. And another way of reinforcing some of the rules of the road with the program. Next slide. Trying to keep an eye on the time here. So this section is literally cut and pasted out of that how to calculate loan amount form. And this is the one with no employees. And it literally brings you right down to find your 2019 or 2020 tax returns, 1040 Schedule C, take line 31 net profit. If it's greater than 100,000, you basically can only include up to 100,000. And it's something as simple as divided by 12 and multiplied by 2.5. That is it. The trick is to when you get into some with employees and how you add everything up, it gets a little bit more detailed than that. Next slide. That goes on and explains the multiply by 2.5. And I've tried to reinforce in here the rules, the form, that how to calculate form does refer to this economic injury disaster loan made between January 31st and April 3rd. Nothing was done by a borrower in Vermont during that window. That's why I've tried to say it's irrelevant. Vermont businesses did not receive any EIDL loans during this window. You don't have to add that in. And then at the very bottom of that section, it explains the kind of information you need in this situation. If you're a sole proprietor with no employees, what you need to bring into your lender to help support your application. Next slide. Then I'm going to be showing you the calculations for the sole proprietors with employees. They said it's very, very descriptive, exactly what you need to do. You're still taking the Schedule C, but it's going to be done in a different way. So you're going to be looking at your net profit and then adding to it the gross wages and things like that from different categories of some of these payroll costs. And then you're going to be continuing on the next page. And that's where you're going to be adding in the group health, life, the disability, things of that nature, retirement plans, and then some of those other areas. You add all of those up based on these instructions, divide by 12 and multiply by 2.5. Now, there are going to be circumstances where if you're a newer company, there are going to be different ways you can look at what time frame. I mean, if you've been in business for 5 years, you can look at all of 2019, all of 2020. It might be the easiest way to look at your tax returns. But if you have tax returns that are only really supporting 6 months worth of activity, there's instructions in here as to how to take that into consideration to make sure that you're doing what's appropriate for you. Next slide. And then again, documentation that's going to be necessary to bring into your lender. Again, it's all very clearly identified in that how to calculate loan amount. Kind of easy here. The loans at the very beginning of the PPP program didn't have this document, didn't have it at all. So a lot of them were trying their darndest to understand the rulings and the guidance that had come out to do this. But these documents are really, really useful. Whether you used it in the first place to kind of, like, if you've already got one, you're thinking about a second draw. These are going to be very useful tools. Next slide. So we're getting down to the end here because I know we want to be moving into some other Q&A possibly. So what is a second draw? What is a second draw? A second draw is simply the second PPP loan that you may have. You can only have one first draw. You can only have one second draw, and not everybody can get a second draw. You have to have already had a first draw loan or any loan up until a new loan, that your first PPP loan. You also have to have used all of the funds, or will be using all of the funds, before a second draw loan can be closed. Closed meaning you get the loan and receive the funds. So you have to have already had the PPP loan. You have to be 300 employees and less. So it's a smaller category of businesses. And you need to be able to demonstrate a reduction in receipts of at least 25% from 2019 to 2020. So that can be on an annualized basis. So all of 2019 to all 2020, if you can prove that your receipts, and there's definitions of what a receipt is, was at least a 25% drop. But it's also can be done quarter by quarter. So if you have fourth quarter 2019 as compared to fourth quarter 2020, if there was a drop in that quarter, you're eligible. You don't have to be eligible for all of the quarters if you have them, or 2 quarters or anything like that. It's a direct comparison there, quarter to quarter. And again, there's going to be some mitigation in cases where a business is newer, and how is that looked at? And that is all outlined in the how to calculate loan amount, because that how to calculate loan amount for a second draw includes a full-throated conversation about gross receipts. What is it? What isn't it? How do you calculate it? What if you're a newer borrower? And then it goes into the organizational type by organizational type, such as Schedule C versus a C Corp. And then it goes through how to do that. So the terms of the second draw are exactly the same. However, most businesses are going to be calculated on 2.5 times their average monthly payroll again. Now, there is a caveat for businesses with an NAICS code that begins with 72, but childcare isn't one of them, so we won't get into that. But this is going to be limited to $2 million, no more. And the same terms, 1% interest rate, 5-year term, same forgiveness criteria, all of that. One of the things you will be needing to do is certify in the application for a second draw, which is a slightly different application. You're going to be needing to confirm that you use the PPP loan proceeds for eligible purposes. For eligible purposes. If you're using them for ineligible purposes, you cannot get a second draw. And again, I have hot links here to a second draw loan application and a second draw how to calculate your loan amount and what revenue reduction is going to be looking like and how to do that. Okay, next slide. So we have forgiveness. As I said, you're going to be potentially eligible for the whole loan and interest to be forgiven for those eligible purposes, as long as those 3 criteria are met. The 60% I kind of explained to you, that's across the board. The next 2 areas, the full-time equivalencies based on 40-hour work week and compensation rate, rate of pay, those need to be maintained. Any one of those 3 can potentially reduce the forgiveness amount, but it doesn't mean you don't get anything. It is not a cliff. You do not fall off the edge of the earth. So if you have 55%, it will be a reduced amount to be able to make sure that that ratio is met. Again, payroll could be 100%. That would be great. But these other areas, I've listed at the bottom here, and I have connection information coming up. I do a very detailed webinar on forgiveness. I also do a very detailed webinar on first and second draw. One of them, the forgiveness, is on Tuesdays beginning at 11:30. The one on Wednesday morning starting at 9 is for the first and second draw. Next slide. So this is the connection information for the forgiveness. The slide after this is on the connection, oops. Yep, for the first and second draw. You can always go to the sba.gov /VT website, which is the Vermont District Office's website. We have a calendar of events that can be helpful, and you can get the information off of that as well. Or you can email me, susan.mazza@sba.gov. I routinely take email questions to try and help people understand the criteria. A number of times people actually find that the level of content, they're pretty content rich. They're very deep. The forgiveness one in particular. Some people get nervous about the forgiveness process. They want to make sure everything is going to be coming out okay. It's useful to go through a forgiveness webinar because then you understand the whole picture. Because all too often you'll say, well, how does this criteria affect this criteria? And I explain all of that. And I have been told that people's anxiety level comes down after my webinars. Next slide. So these are some other sources of assistance. I know that, for example, Center for Women in Enterprise, Women's Business Center, I believe, is doing some one-on-one counseling, although, you'd need to contact them with individual to see what their abilities are at any given time, since there's so much business out there. Vermont Small Business Development Center really is the great place to go for ongoing or resiliency planning and things of that nature. And then we have other SBA partners, SCORE Vermont, and then the microbiz area, business development program. Could reach out to them to see what their capabilities are as well. If you want more information on the PPP program, you can simply go to sba.gov /PPP. Next slide, and I think the next slide is us. My email, Darcy's email, and our office. So I hope that was helpful and not too overwhelming. I hope I'll let other people take over the Q&A here at this point if you'd like to open that up.
Lots of great information. Thank you so much, Susan. And the recording and the slide deck will get shared with all participants. So I know folks are trying to soak it all in, but you'll be able to reference this information for sure. So the chat bar is open. We only have just a few minutes, but certainly Susan and Darcy are available for other questions and have been great responding to things that have already come in. So one question that we received was that if someone received a first round, that will likely be forgiven if they're eligible for a second round. That was one question. And then they asked, can I apply if I did not make less money than the previous year when I figure in the emergency measures taken by the state? So grants and hazard pay that they already received, and that's reported as income. Wonder if someone wants to respond to those questions and if there's any others in the chat bar.
I know that if they've received forgiveness and so forth, the forgiveness amounts and things like that would not be added into the grants. But also a lot of the into the grant idea anyway, in terms of receipts. The how to calculate a section really explains a lot of detail about the receipts. And remember, this comparison could be quarter to quarter. So if you don't get a grant from the state during a specific quarter, and so you can be able to identify quarters that actually didn't have any, you would still look distinctly at those two. You don't have to be adding in something like a grant that may have happened 80, 100 days, 20, in a different quarter entirely. And that can be one way of simplifying your life, more or less, in terms of how am I going to be calculating these and comparing things. I don't know if Darcy had anything additional she would want to add in that regard. In terms of if you're going to be able to apply, I mentioned a little bit earlier that, remember, you need to have used the first PPP loan for eligible purposes. You need to be able to certify that. So if you were not using them for eligible purposes, or let's say you didn't get the whole thing forgiven, you could only get part of it, that's okay. That's okay. As long as they were used for eligible purposes. It doesn't have to be like the whole thing was forgiven before you can go in for a second draw. Hoping that's helpful there. And if people have specific questions about a particular type of a grant or when it was received versus when they have to account for it, they can either, I'm sure, talk with their accountant, or in terms of use of funds too, that Melissa was talking about earlier. You need to be thinking about that in terms of when you want to apply for a PPP loan versus when maybe this grant you might want to approach through DCF, where that might be coming into play, to make sure that there's no overlap there.
Great. There are some questions coming in the chat bar, and I can see Darcy's responding to them. So that's
okay. Okay.
So
she's taking.
Just to reiterate, folks have asked if we will share the slides. We will post both the recording and the slides so that you can reference them. And Susan, as Susan's shared, she hosts weekly webinars about different portions of the process, and those are very accessible. So hopefully folks can get your questions answered.
Yep.
We are coming up on time, so I want to thank everyone for joining and hope that these resources have been helpful as you explore the PPP program. Thanks to our partners at the Child Development Division and the Small Business Association for joining us and helping everyone else out in Vermont.
And thank you, Beth, for forwarding the slides that way. I'm not that familiar with Zoom. We do the Teams thing, so it was really helpful.
Okay, very good. Thank you all. Take care.